So we're going to do a discounted cash flow on Carnival Cruise Lines. And this company has been getting a lot of press lately since the pandemic. And the stock has gone down pretty dramatically. So let's do a analysis to see if it's a buy or not. And this is the best way to identify whether a company is over or undervalued, is discounting the future cash flows of the company. Obviously there's other, so it's 11.3 billion market cap. Yep, 11.3 billion, and the stock price is $14.50. There's other factors involved. You may not think cruise lines are ever going to come back and they're going to go bankrupt. So even if it shows it's profitable, doesn't mean it's going to be profitable in the future. That's outside the realm of the discounted flat cash flow model. But this is a good tool to identify value or not. That's a big drop in cash flow. It was 2 billion, 2 billion, 1.8 billion, and it dropped to 46 million in 2019. And that's the best indicator of a company's future success is cash flow. Net income can be manipulated because you depreciate assets, which doesn't identify the entire cash flow in and out, where that's exactly what free cash flow is. It's cash flow from operations minus capital expenditures. So it's pretty much all the cash flow that's left over after running the business. And we also need a revenue, and that's usually more consistent revenue, because usually you can't manipulate it too much. It is what it is. Where other things can be a little more lumpy, like free cash flow. If they purchase a lot of ships in 1 year, so their cash flow may be really low for a particular year, like in 2019, if they did a lot of upgrades on their ships. But usually in an income statement, it's amortized or depreciated, so it's kind of smooths out those big purchases. Now we need to look at the capital structure of the company so we know what to discount. So we need the interest expense, and it's 206 million. You got to be careful that you enter it correctly. And the balance sheet, so the current debt is 1.8 billion, and that current debt is debt due within a year, and the long-term debt is debt due beyond a year, and that's about 10 billion. So they pay a really low interest rate, 1.79% on their debt, and it's pretty low. Maybe they negotiated because instead of filing bankruptcy, maybe their creditors let them pay a lower rate. You can find that in the 10K. Now we need the income before tax. And the income tax, that's really low, 2%. But it looks like it's low every year. I'm not sure why. They may have taken a lot of losses in prior years and they're rolling them forward. We need to sift through a 10K to really identify why the income tax is so low. But I don't think that's feasible. I'm going to just force a 20% income tax, because in future years, that's probably what it should be closer to. So I'll force a 20%. So even though they paid 1.79% on the debt, on the interest on the debt, they do get a tax write-off. And the cost of the debt after the write-off is 1.43%. And now we have to look at the cost of their equity. And we need the beta. It's a pretty high beta, 1.96. A beta of 1 means the stock moves with the market, the broad market. A beta of 2 means the stock moves twice as much as the market, whether up or down. So the blended cost of their debt, the cost of debt, the 1.43%, and the cost of equity, which is 17.37%, we need a blended rate, and that's 9.34%. And we call that the weighted average cost of capital, or the WACC. And they have exactly 50% debt, 50% equity. That's interesting. It can't be exactly, yeah, it's rounded to 50%. So that's what we have to discount the future cash flows by. And we figured out the future cash flows by putting in the net income, revenue, and free cash flow into the model, and it calculated the future free cash flow of the company, also with the terminal value at the end. And if you discount the future value of the company back to today's dollars, it's worth $17 billion, the company. And with 781 million shares outstanding, the estimated stock price is actually $22.07. So they are selling at a discount, a 34% discount. That might not be the best discount for this company, because they're going to be losing a lot of money this year and next, because I don't think many people are going to be using their services. So that's interesting. $22 stock price, that's what we come up with. And let's look at the past 5 years. So they were trading in the 40s, and just recently they fell below 22, just within 2 months. So they were trading at a premium. Now they're trading at a discount, just because of the forces of the market and the concern that people aren't going to be using their ships anymore, and they may go bankrupt. That's also a concern as well. So this is a buy according to the discounted cash flow model, but you may not think it's a buy based off of other things that are going on. Thanks for watching.